What if I told you the 1929 stock market crash wasn't a failure of capitalism, but a flawlessly executed heist? Not a collapse, a controlled demolition. And the blueprints? They were sitting in Federal Reserve archives this entire time, gathering dust while you paid your mortgage, worked overtime, and watched your savings account earn 0.2% interest. Here's the thing nobody wants you to connect. In 1929, everyday Americans borrowed money from banks to invest in stocks. The loans were called call loans, meaning banks could demand full repayment with zero notice, 24 hours, sometimes less. And on October 24th, 1929, they called them all at once. Not because they had to, because they wanted to. The Federal Reserve, the institution that's supposed to prevent financial panics, stood by and watched. Actually, scratch that. They actively tightened the money supply right before the crash, choking liquidity out of the system like wringing water from a towel. Sound familiar? It should, because your student loans, your credit cards, your variable rate mortgage, they're all built on the same psychological architecture. Debt that can be weaponized the moment it's convenient. Real quick, drop a comment and tell me where you're watching from. And if you want the unfiltered truth about how modern finance really works, hit subscribe. This isn't financial advice, this is financial archaeology. Because what happened in 1929 wasn't chaos, it was the script, and we're still following it. Let's rewind to 1928. The Roaring Twenties are in full swing. Jazz, flappers, prohibition, and the stock market, absolute euphoria. Between 1924 and 1929, the Dow Jones Industrial Average climbed from 95 points to 381, a 300% gain in 5 years. Regular people were becoming millionaires overnight. Shoeshine boys were giving stock tips. Everyone was in the market. But here's what they don't teach you in economics class. Most of that wealth wasn't real. It was borrowed. Enter the call loan market, the financial weapon of mass destruction nobody saw coming. Here's how it worked. You wanted to buy $10,000 worth of stock, but you only had $1,000, no problem. Banks would lend you the other $9,000 through something called a margin loan. You'd put down 10% and the bank financed the rest. But here's the catch, and this is where it gets sinister. These loans were callable. That meant at any moment, for any reason, the bank could demand full repayment. Immediately, no warning, no grace period. Sound familiar? Because that's exactly how your credit card works. Your bank can change your terms, jack up your interest rate, or reduce your credit limit at any time. They call it risk management. It's the same playbook. By 1929, there was $8.5 billion in outstanding margin loans, equivalent to over $150 billion today. The entire stock market was a house of cards built on borrowed money, and the banks held the match. Now, here's where the Federal Reserve enters the story, not as the hero, but as the accomplice. In early 1929, the Fed started raising interest rates. They called it cooling down speculation. But here's what actually happened. They made borrowing more expensive, which meant banks had to charge higher rates on those call loans. Higher rates meant lower profits for banks. Lower profits meant banks wanted their money back. And in August 1929, just 2 months before Black Thursday, the Fed raised rates again from 5% to 6%. Sound familiar? Because in 2022 and 2023, the Federal Reserve raised interest rates 11 times in a row, from 0.25% to over 5%, the fastest increase in 40 years. They called it fighting inflation. The result? Banks collapsed. Silicon Valley Bank, Signature Bank, First Republic. Credit dried up, layoffs started, same script, different decade, better suits. But back to 1929, the trap was now set. Banks were paying higher interest to the Fed, which meant they needed cash fast. And where could they get instant cash? By calling in those margin loans. On October 23rd, 1929, call loan rates hit 12%. Some banks were charging 20%. The next day, October 24th, 1929, forever known as Black Thursday, the dam broke. Banks across New York started calling their loans. Thousands of them, all at once. Here's what that looked like in practice. You're a school teacher in Brooklyn. You borrowed $5,000 to buy stock in RCA and General Motors. Yesterday, your portfolio was worth $7,000. You're up 40%. You're planning a vacation. Then your phone rings. It's the bank. They want their $5,000 back. Today, right now. But you don't have $5,000. That money is tied up in stocks. So you do the only thing you can. You sell your stocks to raise cash. Now multiply that by hundreds of thousands of people, all selling at the same time. Prices collapse. Your $7,000 portfolio is now worth $4,000. But you still owe the bank $5,000, so you sell everything. And you still can't cover the loan. Sound familiar? Because that's exactly what happened in 2008 with housing. People borrowed against inflated home values. When the market crashed, they owed more than their homes were worth. Foreclosures, bankruptcies, lives destroyed. The mechanics are identical. The asset class changes, stocks, houses, crypto, but the trap is the same. Within 5 days, the stock market lost $30 billion in value, nearly $500 billion in today's money. But here's the part that should make your blood boil. While ordinary Americans were being wiped out, the banks knew exactly what was coming. They called the loans, they created the panic, and then they bought assets at pennies on the dollar. J.P. Morgan & Co. didn't collapse in 1929. Neither did Chase National Bank. They got stronger, they consolidated, they absorbed the failed banks. The crash didn't destroy the banking system, it concentrated it. And the Federal Reserve? They didn't ride to the rescue until 1932, 3 full years later, after 9,000 banks had already failed and unemployment hit 25%. Sound familiar? Because in 2008, the Fed bailed out the banks within weeks, but everyday Americans lost $9.8 trillion in wealth and got nothing. The pattern isn't a coincidence, it's a feature. Now, here's where the story takes a dark turn, because there's a name you need to know. Benjamin Strong. If that name doesn't ring a bell, it should. Because Benjamin Strong was the governor of the Federal Reserve Bank of New York from 1914 to 1928, the most powerful financial position in America during the Roaring Twenties. And he had a secret. Throughout the 1920s, Strong kept interest rates artificially low, between 3% and 4%, which made borrowing cheap and fueled the stock market bubble. He was friends with the major bankers. He socialized with them. He coordinated with them. In 1927, Strong met secretly with the heads of the Bank of England, the Bank of France, and the German Reichsbank at a private estate on Long Island. No public record, no transcript. Just 4 central bankers deciding global monetary policy behind closed doors. What did they discuss? Officially, currency stabilization. But here's what we know happened next. Strong cut U.S. interest rates, again, flooding the market with cheap credit, supercharging the stock bubble to even more absurd heights. Why would he do that? Because European banks needed to rebuild after World War I, and low U.S. rates made European bonds more attractive, pulling gold back to Europe. In other words, the Federal Reserve was manipulating American markets to bail out European banks. Sound familiar? Because in 2008, the Fed secretly loaned $16 trillion to foreign banks, including the Royal Bank of Scotland, Deutsche Bank, and the Bank of England. The American people weren't told until years later when Bloomberg sued under the Freedom of Information Act. The playbook hasn't changed. But here's the twist. Benjamin Strong died in October 1928, exactly 1 year before the crash. Convenient, right? His replacement, George Harrison, immediately began raising interest rates, the exact opposite policy. The cheap credit tap was shut off. The call loan trap was armed, and within 12 months, the market imploded. Coincidence or coordination? Because the meeting minutes, the actual documents, were sealed for decades. And when they finally surfaced, whole sections were redacted. You won't believe the name that appears in those documents right before the redactions. But first, you need to understand exactly how the call loan system worked, because this is the receipt that proves intent. Let's get into the guts of this machine, because once you understand how call loans worked, you'll see the same mechanism in every financial crisis since. The call loan market wasn't some obscure financial experiment. In 1929, it was an $8.5 billion industry, the largest pool of borrowed money in America. To put that in perspective, the entire federal budget in 1929 was only $3.1 billion. Wall Street was running on more borrowed money than the entire U.S. government was spending. Here's the structural trap. Step 1. The bait. Banks advertised margin loans as easy money and financial freedom. You could buy stocks with only 10% down, sometimes as little as 5%. The ads were everywhere. Newspapers, radio. Banks even set up brokerage desks in their lobbies so you could deposit your paycheck and buy stocks in the same visit. They made it frictionless. They made it exciting. They made it feel safe. Sound familiar? Because that's exactly how Robinhood, Coinbase, and every crypto exchange operates today. Gamified interfaces, instant approval, fractional shares. Investing made easy. The psychological hook is identical. Wealth is just one click away. Step 2. The leverage multiplier. Once you were in, the system encouraged you to borrow more. If your $1,000 investment grew to $1,500, banks would lend you another $4,500 so you could buy even more stock. This is called pyramiding, using borrowed money to buy more assets, then using those assets as collateral to borrow even more. By 1929, some investors were leveraged 20 to 1. That means for every $1 of real money, they controlled $20 worth of stock. Here's the math. If the market went up 5%, your $1 became $2, a 100% gain. You felt like a genius. But if the market dropped 5%, your $1 became $0, and you still owed the bank $19. This is called moral hazard. The system rewarded reckless risk because the upside was unlimited and the downside was someone else's problem. Sound familiar? Because that's exactly how the 2008 housing crisis worked. Banks bundled subprime mortgages into securities, leveraged them 30-1, and when the music stopped, taxpayers ate the losses. The leverage changed. The scam didn't. Step 3. The illusion of liquidity. Here's the truly sinister part. Banks told investors that margin loans were safe because the stock market was liquid. Meaning, if the bank ever needed their money back, you could just sell your stocks instantly and repay the loan. Easy. Except that only works if you're the only one selling. If everyone tries to sell at the same time, there are no buyers. Prices collapse, liquidity disappears, and the banks knew this. Internal memos from National Citibank, now Citibank, show executives warning in early 1929 that margin loans had become, dangerously concentrated, and that a coordinated withdrawal could precipitate disaster. They knew, and they kept lending anyway. Why? Because they were making 12% interest on those loans, higher than any other investment. It was too profitable to stop. Sound familiar? Because in 2021, banks were making billions in overdraft fees, even though internal research showed these fees disproportionately hit poor customers and trapped them in debt cycles. They knew. They didn't care. Greed isn't a bug in the system, it's the operating system. Step 4, the coordinated strike. Now, here's where it goes from predatory lending to engineered collapse. In the weeks before Black Thursday, the largest banks in New York, JP Morgan, Chase National, National Citibank, quietly started reducing their margin loan exposure. They called in loans from small investors and regional banks first, the little guys, the ones who couldn't fight back. By October 1929, the big 6 banks had reduced their margin loan portfolios by 18%, while regional banks had increased theirs by 23%. The major banks were getting out, the small banks were being set up to fail. And then, on October 24th, the trap was sprung. At 10 a.m., brokers across Wall Street received identical telegrams from their banks. Call all margin loans, immediate repayment required. Not some loans, all loans. Within 30 minutes, the New York Stock Exchange was flooded with sell orders. The ticker tape, the machine that printed stock prices, fell 2.5 hours behind. Nobody knew what anything was worth anymore. Panic. By noon, $9 billion in market value had evaporated. But here's the smoking gun. The telegrams were sent simultaneously, not staggered, not random, at the exact same time. That doesn't happen by accident. That's coordination. And guess who was in the room when those decisions were made? Representatives from the Federal Reserve Bank of New York. The meeting minutes exist. They're in the National Archives. But the section detailing recommendations regarding call loan management is heavily redacted. What were they hiding? Step 5. The consolidation. Here's what happened next. And this is the part that proves intent. After the crash, when stocks were trading at 10% of their peak value, the same banks that called the loans started buying. JP Morgan and Coopers acquired $100 million in distressed assets in November 1929 alone, worth over $1.7 billion today. Chase National Bank absorbed 3 smaller banks that failed during the crash, doubling its size overnight. By 1933, the top 10 banks controlled 57% of all banking assets in America, up from 38% in 1928. This is called disaster capitalism, engineering a crisis, then buying assets at fire sale prices while the public is too devastated to resist. Sound familiar? Because in 2008, JP Morgan bought Bear Stearns for $2 per share, a company that had been worth $170 per share a year earlier. They paid $1.2 billion for a firm with $18 billion in real estate assets. Bank of America bought Merrill Lynch for $50 billion, half its pre-crisis value. Wells Fargo absorbed Wachovia. The big got bigger, the small disappeared. Same script, same ending. Step 6, the Federal Reserve's role. Now let's talk about the Fed's complicity, because this is where the conspiracy becomes undeniable. The Federal Reserve Act of 1913 gave the Fed one job: to furnish an elastic currency and prevent financial panics. In 1929, they had the tools to stop the crash. They could have 1. Lowered interest rates to reduce call loan pressure. 2. Provided emergency liquidity to banks facing margin calls. 3. Suspended call loan contracts temporarily under emergency powers. Instead, on October 24th, the day of the crash, the Fed raised the discount rate from 5% to 6%, making it more expensive for banks to borrow emergency funds. Why? The official reason was protecting the gold standard, because once the smoke cleared, the Fed argued that the crisis proved banks needed more regulation, more centralized control, more Federal Reserve oversight, and Congress gave it to them. The Banking Act of 1933, Glass-Steagall, and the Banking Act of 1935 massively expanded Federal Reserve powers, giving them control over reserve requirements, discount rates, and open market operations, tools they could use to manipulate the entire economy. The crisis wasn't a failure of regulation. It was an opportunity to seize more power. Sound familiar? Because after 2008, the Dodd-Frank Act gave the Fed unprecedented authority to designate systemically important institutions and regulate them however they wanted. The numbers that prove it. Here are the receipts. 5 statistics that quantify the crime. 1. $8.5 billion in outstanding margin loans in 1929, more than double the federal budget. 12% to 20% call loan interest rates in October 1929, predatory by any standard. 18% reduction in margin loan exposure by major banks before the crash, proof of foreknowledge. 4. $30 billion in market value lost in 5 days, equivalent to $500 billion today. 25% unemployment by 1933, the human cost of financial engineering. These aren't estimates. They're from Federal Reserve archives, the Senate Banking Committee hearings of 1932, and the historical statistics of the United States. The data is undeniable. The call loan market was a weapon. The banks pulled the trigger. The Fed provided the ammunition. That's not a market failure. That's a transfer of wealth. That's theft masquerading as economics. So here we are, 95 years later. Do we have call loans anymore? No. We have margin accounts with instant liquidation clauses. We have variable rate mortgages that can reset without warning. We have credit card agreements that give banks unilateral authority to change terms for any reason at any time. And the stakes are higher now because the system is faster, more leveraged, and more interconnected than ever. Lose $30 billion. In 2010, the flash crash wiped out $1 trillion in market value in 36 minutes, and nobody knows exactly why. High-frequency trading algorithms, automated sell orders, financial weapons that execute trades in microseconds, and the Federal Reserve. In 2020, they printed $4 trillion in 9 months to stabilize markets during COVID. That's more money than existed in the entire U.S. economy in 1929. Where did it go? To the stock market, to corporate bond buybacks, to the wealthy. Meanwhile, 40% of Americans can't cover a $400 emergency expense. The 1929 playbook isn't history, it's prophecy, because the system isn't designed to prevent crashes. It's designed to profit from them. Drop a comment. Tell me if you think the next crash is coming, or if it's already here and we just don't see it yet. And if this video made you question everything you thought you knew about financial history, subscribe, share this with someone who needs to hear it. Because the truth isn't hidden in some government vault anymore. It's right here, in the patterns, in the numbers, in the script they keep running over and over again.